Imagine two people. One earns a salary, the other owns things. The first one pays tax every single month without fail. The second one sometimes pays nothing at all. Same country, same laws, very different rules. And no, it is not because the rich are cheating. It is because the system treats income and wealth as two completely different things. Today, I will explain how rich people legally pay zero tax. Explain like you are five. Most people think taxes work like this. You make money, and then the government takes a piece. That is true, but only when it comes to income. What most people do not realize is that rich people do not live on income. They live on assets. Assets are things that can grow in value over time, such as businesses, shares, property, and intellectual property. Here is the first rule of the system. You are usually taxed when money moves, not when money grows. If something grows quietly, taxes stay quiet too. Let us simplify. If you earn $1,000 in salary, tax is taken immediately before you even touch the money. But if your shares increase in value by $1,000, you are not taxed. Why? Because the system only taxes what is called realized gains, which means you must sell something first before tax is triggered. So if you never sell, you never trigger tax. That is why you sometimes hear headlines like, "Billionaire wealth increased by billions, paid no income tax." That is not a loophole. That is exactly how the system was designed. Now you might wonder, if the rich never sell their assets, how do they live? The answer is simple. They borrow. When wealthy people need spending money, they do not sell their assets. They borrow money using their assets as collateral. To the tax system, income is taxable, but loans are not considered income. So a billionaire can borrow millions of dollars, live off that borrowed money, and pay no income tax at all. Is borrowing money free? No. But when your assets are growing faster in value than the interest on your loan, borrowing becomes cheaper than paying tax. This is legal. It is boring. And it is completely inaccessible to normal people who cannot borrow against stocks, art, or companies. Here is something that sounds wrong, but is true. Losses can actually reduce taxes. Businesses are allowed to subtract their losses from their profits. If a company loses money this year, it is often allowed to use that loss to reduce taxes in future years. This rule exists to encourage risk-taking and investment. For small businesses, this helps them survive hard times. But for large companies, this same rule becomes a long-term tax planning tool. The rule is the same. The scale makes the outcome very different. You pay tax on income, but corporations pay tax on profit. Profit is calculated by subtracting expenses from income. Salaries that a company pays to its employees are considered a business expense. Research spending is considered a business expense. Marketing spending is considered a business expense. Because of this, a company can generate massive revenue, but after subtracting all allowable business expenses, it can legally show very low taxable profit. That is not cheating. That is accounting, fully allowed by governments because it encourages hiring people, investing in innovation, and growing the economy. But the side effect is obvious. Normal people feel squeezed, while companies feel optimized. Here is a quiet truth. The system does not hide wealth. Complexity hides wealth. Wealthy people do not usually own things in their own name. They spread their wealth across multiple companies, multiple jurisdictions, and multiple legal layers. Not to break the law, but to spread risk, manage ownership, and plan taxes. Most normal people have one job, one bank account, and one tax form. Complexity is not evil, but it is powerful. And it is only available to those who can afford experts to set it up. This entire system feels unfair, and that is because it is. The tax system was originally built around work, wages, salaries, hours. But modern wealth is built around ownership, shares, equity, assets. And the system never truly caught up with that shift. So workers often feel punished. Owners feel protected, not necessarily because someone intentionally designed it that way, but because laws evolve slowly while money evolves fast. So why does the government not simply change the rules? Because taxing wealth is extremely difficult. Assets are hard to value. Markets constantly go up and down. Capital can move across borders with the click of a button. Countries compete with each other for investment. If one government raises taxes too aggressively, wealthy people simply move their money elsewhere. So governments compromise, and compromise creates gaps. Here is the real takeaway. This is not a story about villains. It is a story about incentives. The system rewards ownership over labor. It rewards patience over wages. It rewards complexity over simplicity. That is why the rich do not panic during crashes. That is why taxes often feel heavier at the bottom than they do at the top. And that is why understanding the system matters more than hating it. You do not need to like this system, but now you understand it. And once you understand how money really works, you stop blaming individuals and you start questioning structures. That is where real change begins.